Let's keep the conversation going with more on the markets. We've got Franklin Templeton Fixed Income Chief Investment Officer, Sonal Desai. Sonal, it's good to talk to you. As Jared said, the Fed reiterating, we really mean it this time. Looking at, where the bond yields have been moving, we've seen some big swings this week. Do you get the sense that the message is finally getting across?
I don't know. That's the answer. Next week, I think that on almost a technical headline impact, you're likely to see low CPI print. That might not be the beginning of a trend of CPI continuously going down. It's quite likely that in September, in month-on-month terms, CPI could pick up again. I don't yet think we're at the point of seeing sustained downtrend in CPI to the level and core PCE, which of course the Fed is looking at, but the headline certainly matters, to levels which the Fed is going to be comfortable with. So I think we're going to see a lot more volatility still. I don't think that the message, if we want to call it a message, is finally through. We're looking at a market which is coming on close to 20 years of never actually having seen a Fed that hasn't backed off if data looks even marginally weaker or if markets look marginally weaker.
Yeah, on that front, we did also hear from the Fed's vice chairwoman, Lael Brainard, yesterday, who essentially said that one print in terms of inflation isn't going to do it for us. She said specifically it's going to be necessary to see several months of low monthly inflation readings to be confident that inflation is moving back down to 2%. What kind of timeline are we looking at?
So for me, this year is completely out of the question. I think that there is every possibility that we would end the year closer to 7.5%. That's quite possible mathematically. It's not a stretch to expect CPI now that I'm talking about, headline, ending the year closer to 7 than to the 5s or 6s that I think a lot of people in the market are hoping for. I think the type of numbers we're looking at realistically, I don't see them happening for a large part of next year either. We will start seeing inflation come down, but what Fed Chair Powell has been at pains to talk about is a fairly infamous episode in the 70s when the Fed did stop raising, started cutting too soon, and inflation came roaring back. And it's just harder the second time around. So I doubt that the Fed is going to be prepared to make that particular error. And there's going to be pain, which comes with it in terms of higher unemployment.
Obviously,
and I think the Fed,
obviously, inflation, not just a U.S. story. We did see the ECB this morning raise rates 75 basis points. Inflation certainly really hurting there. And we're not even in the thick of things during winter. What does that mean from an investment standpoint as you see it?
So I think that globally, it's absolutely true that inflation is picking up. It's up, and we're seeing rates go up, be it Canada, be it the UK, be it the ECB. I think we're going to see this. But what is really interesting is that the European case is very different. The drivers are enormously different than what we have here in the US, because it's almost coincidental that headlines have been relatively close to one another, given that the European inflation drivers are so little demand and so much a supply shock, whereas in the US, there are very clear indications that it's also demand. So I think globally, it doesn't make for a very attractive environment for bonds, no doubt, in the near term. But as we go further forward, I think we will be in a position to see central banks come to a peak of a cycle, at which stage bonds start looking much more attractive again.
And really quickly, Sonal, just bringing the conversation back to the U.S., the Fed meeting coming up later this month is 75 basis points. Is that your base case right now?
It's very likely, but I think the bigger point is it doesn't really matter. What is quite likely is we will get some mixture of 75-50-25 or 50-50-50. I don't think we're getting 150 basis points of more in rate hikes this year. It makes sense to front load it since the market is anticipating it. The market might start pricing this out next week if we get a benign inflation print, but I think it's not very likely.
Sonal Desai, it's good to get you on today. Franklin Templeton Fixed Income Chief Investment Officer.